And to help us understand what to make of the current market setup, I'm now joined by Dalin Pinto, who's a senior fund manager equities at Bandhan AMC. Thank you very much, Dalin, for joining us right here on ET Now, and thank you very much for taking the time out. I want to understand from you the kind of recovery that we've seen in the markets, and of course now a bigger rebound for the mid-cap and small-cap indices as well. Do you think we've bottomed out for good?
Yeah, good afternoon. Thank you for having me on the show. I think, after 5 very good years, as far as the markets are concerned, the markets are going through a phase of consolidation. And this is something that we witnessed in 2021 as well, where the markets pretty much stayed range bound for almost 4 to 6 quarters, post the Russia-Ukraine war. This time around, of course, it's a lot of talks about, tariffs. There's a lot of talk about a global recession. And there's also the incremental data point on the fact that we are slowing down as an economy as well, right? So I think it's fair to expect that we do continue to consolidate for a couple of quarters. And we do have quite a few data points to look forward to over the next couple of months, starting with April 2nd, of course, followed by the RBI policy meet, and then a very, very important result season, which I think will set the tone as far as we are all concerned for the FY26 earnings outlook, which I think is critical as far as the market is concerned.
Okay, good afternoon, Dylan. This is Snehi also joining in on the show. I'm just taking a look at some of your mutual fund holdings. I'm taking a look at the Sterling Value Fund right now. I can see that you're quite underweight on capital goods. On the flip side, there's an overweight coming in on financial services. Help us understand the rationale. We believe that financial services are, in the leg up for a good run. This is what we understand with our interaction with other analysts as well. But what would be the rationale behind the underweight on capital goods, given that the budget has been decent enough in February? So what's driving this rationale of being underweight on capital goods? And if also broadly you could share with us the other sectors that you are underweight or overweight on.
Sure. So I think our underweights on capital goods and infrastructure in general are premised on 2 aspects. I think one is valuations had gotten very stretched for a whole host of these companies over the last year or so. There was too much euphoria and optimism being built into earnings estimates. So I think that is one reason that made us reduce our exposure. The second is, as far as the overall spending environment is concerned, I think we've kind of hit a near-term cap as far as the amount of capex that the government can do. So we would require much more participation, I think, from the private sector to actually take us to the next level as far as capex growth is concerned. At this point of time, given the slowdown that we are seeing across segments, demand continues to be missing in many categories. We really don't think that private capex is really going to kick off in a big way, at least for the next couple of quarters. So that really sums up why our capital good underweight stays at this point of time. On the flip side, private financials, which is where we are most overweight at this point of time. One is I think valuations continue to remain fairly attractive, and more importantly, I think recently we've seen policymakers start to focus more on providing liquidity, start to focus more on looking at regulations which could potentially improve credit growth, and I think these are 2 areas which have concerned most investors, especially when it comes to looking at financials over the last year or 2 years. So I think at the margin, we are seeing improvement in the overall environment for the financial sector, while we are seeing deterioration and possibly earnings downgrades for the capital goods sector as such.
All right, Mr. Pinto, let me also ask you about the new April series. Who do you think are going to be the new leaders?
Oh, I think that's too short a time period for me to really comment on. I think April's really going to be driven by how the earnings of companies pan out. So I think that's really the way I'm looking and waiting and watching as far as the market is concerned.
Mr. Pinto, I was looking at this portfolio once again. You're slightly overweight when it comes to auto, a very nominal overweight coming in, but nonetheless, it's a positive stance on auto. Now, we've recently heard this announcement of Trump imposing 25% tariffs on the auto space and auto anks. Would that change your positioning in the portfolio when it comes to autos?
Yeah, so that's a good question. I think, when you look at autos as an entire landscape, I think Indian autos is fairly domestic oriented, right? So whether you look at two-wheelers, you look at tractors, you look at cars, you look at CVs. So the entire gamut, I think most of the Indian companies are fairly, domestic focused, with the odd exception of, one or two that do export, but not primarily to the US, right? So I think to that extent, these tariffs don't really rock the boat as far as the Indian auto names are concerned. When you look at tariffs overall, I think where we could see a little more pain as far as the auto sector is concerned is on the auto ank side. I think we're all still awaiting a little more clarity as to how those tariffs will shape up for the auto ancillary companies, because there could be not only a direct impact to those companies that export to the US, but there could also be an indirect impact to companies that export to other car makers around the world, who in turn export cars to the US. So ANKs would be a little more worrisome as compared to the OEMs, where exposure is much more towards India than to having any direct links to the US as such.
Right, Mr. Pinto, and a very valid point that's been made. In fact, that's the big headline today, those, tariff of 25% coming in from Donald Trump. And of course, recent news update also coming in that there will be higher tariffs on EU and Canada if they work against the United States. So everybody is waiting and watching out for April the 2nd. But let me also ask you, how should investors then look at positions? Should they be holding? Should they be in a wait and watch mode, considering that most of it is just a lot of uncertainty?
I think that's a great question. We are all, I think, pretty much in wait and watch mode. And I think when you look and talk to corporates as well, I think they have the same sort of doubts that everyone has, because until with some sort of clarity as to what kind of tariffs could potentially be imposed in your business, it's very difficult for you to make any incremental capital allocation decisions as such, right? And I think that's where we believe the market is much more optimistic in general, that tariffs will probably not fructify or not be as disruptive as what it appears, and won't potentially cause a recession. So I think it's a little too early for us to get too bullish or to change our view from being in a wait and watch mode on this front. I think let's hold out for a couple of days till April 2nd and let's see what happens.
Okay, on that note, Mr. Pinto, we'll let you go. Thanks so much for joining us and sharing your market outlook with us.
If you like this video, then like, share and subscribe to ET Now.